All right, everybody. Well, welcome to 8 Cash Flow Drivers. And I'm super excited to have everybody on. I don't see a lot of cameras. If we can get you on screen, that would be super helpful. We're going to dive right in. Um, Let me start with the agenda. We're going to be going over the importance of financial data, looking at 5 key numbers. We're going to be looking at finding the drivers, measuring the drivers, the impact, and then next steps. And what I want you to come away with actionables today. Also, as we're going along, if you have questions, I really want you to dive in and ask those questions. There's the reaction down at the bottom. There's a raise hand function. That's going to be the easiest, but Mallory's also watching. If you're jumping up and down and saying, Mallory will jump in and let you know. Okay, so what's the format? The format is, when we do these workshops, it's the same every time. There's going to be education. I'm also going to give you some examples from my prior career in the pest control industry back at my company, Cooper Pest. Try to give you some anecdotal things that you can look at. We're going to talk about a little bit about build to sell and drivers evaluation and the drivers and impact, because I believe very strongly that they all wrap around into 8 cash flow drivers. We will also have 2 working breakouts, and it says 3 to 4 people per room, but that's not what we're going to be doing today. Actually, I have to fix that slide for today. That's normally what we do. I'm taking it down today. I want 2 people in each room, ideally not in the same company, because I want this to be a little bit tighter. It's a little more harder work, and it's going to be, it'll be easier if we do it with 2 people. So let me dive right in. And where I want to begin when we're talking about 8 cash flow drivers is the concept of a strong financial team. When we're doing this, it's finding the drivers, measuring, doing all this stuff can be hard work. And I believe, and I press my clients that they surround themselves with a really strong team. And you're going to see at the end, I'll be recommending, I tell you who I love to surround with and people that you can, but you've got to have a strong accounting firm. I also believe that you want to have some kind of exit planner around you, even if you are not planning on selling. Building to sell is a concept where we're making our companies stronger. And when we get into 8 cash flow drivers and the financial stuff, understanding what drives the valuation of your businesses is very important. I also believe as we go through this, we're going to be talking a lot about profit. And so there's also the ability when we're looking at 8 cash flow drivers to build incentive plans. And they're, finding a company that knows how to build these plans, and especially building them around profit, can be very helpful. Also making sure that your teams are financially fluent. So surrounding yourself with people that can help build the financial fluency. And we're going to be doing some of that today, but increasing that, and also potentially if you're not strong in the finance seat, thinking about fractional. And with all that, if we have this team and what you're doing here, where I like to begin is you have to know your numbers, because if we're going to find the drivers, if we don't know the numbers, we have problems. And so in the world of EOS, this is the data component, and that's where we're spending today's time in. So these are the 5 numbers that I believe you need to be obsessing over. And when we think about drivers, we want to be saying what's driving these numbers. We need to, of course, be obsessing over revenue, but we need to be obsessing over gross profit and gross margin. We need to be looking at OpEx, and we need to be looking at net income. We need to be knowing these numbers at all times. We should know them like that. I can't tell you how often I find clients that don't know these numbers off the top of their head. They have to start looking in start pulling out their financials and looking at numbers. This should just be second nature. The other number that I love for my clients to look at is free cash. So adding, free cash would be the other number that we would look at. And when I'm looking at these numbers, the other thing I want to, again, we're talking some basic stuff, but I think it's very important. Are we looking at dollars, or are we looking at percentages? And again, critical. Revenue, I'm looking at the dollar amount. What are the dollar goals? But gross margin, I'm looking at the percent. What is my percent of gross margin? When I look at OpEx, I'm not looking at percentage. I am worried about percentages, but what I'm worried about is my OpEx staying consistent quarter to quarter, month over month, from a dollar perspective, because that should be staying fixed. That shouldn't be moving a whole lot. My net income, clearly I'm looking at percent. And again, if I'm looking at free cash, I'm looking at dollars. So when we're thinking about drivers, I focused on what were the two, the Cooper example here is what were two major drivers that were driving things at Cooper? And I said, what drives revenue? What drives gross margin? And again, thinking about there was, those five drivers: revenue, gross profit, gross margin, OpEx, net income. I could make number 6, free cash. I decided we were going to focus on revenue and gross margin. And so when we thought about gross margin, my inclination immediately was, who drives this? I said, it's the service managers driving it to the technicians, that they're delivering service in the field in the pest control industry. And because those people are doing the work, they're going to drive gross margin. But as we thought more about it, and we really started to pick it apart, well, we said our first cash flow driver was service delivery. That if we delivered service great, that gross margin should go up. Now we're going to talk about how we did that and where we thought about that later on, but that's what went on in our heads. And so that was the first driver that we chose. Then we had to think of, then we went to revenue and we said, what was our revenue driver? And as we picked it apart, so it's so easy to say it's our sales people in the field and it was our selling team. But what we knew and what we relentlessly focused on was customer retention, because we knew that would magnify our sales effort. And so that became our second cash flow driver. And we knew it would take a lot of it was going to take hard work. It took hard work to find those. It wasn't so obvious. I'm going to challenge everybody on this workshop today that finding your drivers and your measurables is hard work. And today we're going to ask you to find one or two of your 8, and we'll show you what that looks like in a moment. But starting tomorrow, maybe even starting when you get off the call, thinking about this is critical. That I want you to keep working and working till you find the 8 most impactful drivers in your business of revenue, of cash, of profit, the things that drive those numbers so that you can be relentless on them. And it also starts with surrounding ourselves with great people. It's where I started with the team. So here we're going to go to our first breakout. I want you in a moment with the person that you're paired with to take 10 minutes, and I want you to talk through with that person what are 1 to 2 items in your company that really drive revenue, gross margin, OpEx, net income, or free cash. And we're going to report back. But here's what I want you to ask. What driver did you find? Why is it an important driver? And then, more importantly, what drives the number? Think about, in my example, what drives customer retention? In my example, what drives that service manager making those technicians great to deliver that service delivery? So that's where I want you to go in your heads. And then when we get back, we're going to report back in, and then we're going to take this and we're going to magnify it as to how we then look at that driver and how we measure and where we take it to the next level. So Mal, if you can send everybody out for a breakout.
Yep.
Hey, everybody. Okay, we should all be back. So, where we're going to go. Before we report out, I just want to refer you to this book. It's a great book. It's was written within the last year by Mark Stanley and Angela Kalmus, along with Mark O'Donnell, who's the visionary of EOS Worldwide. But it's a great read. And I've had lots of conversations with Mark about this. As you go through today, this is just a wonderful book that really goes through the data component of EOS, the 8 cash flow drivers. It'll match up to what we're talking about today. But as you're moving forward, a great read. And I wanted to go there because I'm sure your heads are swimming a little bit. So I'm curious what you found. Who would like to go first? Which of the breakouts would like to tell me what driver did you find? Who's going to be my brave one out there? So quiet.
I'll go for it.
Okay.
Hello, everybody. Will Shields, Blue Star Chesapeake, painting and bath and kitchen renovation firm out of Maryland. Matt Kay and I were in a breakout room, and AR, accounts receivable, is a major cash flow driver for us. If you don't have cash in the bank or your eyes on who owes you what, it puts you in a more defensive and reactive position towards collections rather than proactive, focusing on bigger pictures. If you don't have cash, you don't have anything.
So within Blue Star, what drives AR?
That's a loaded question. I would say our collections process, coming up with putting in our sales process, the client expectation on first meeting. This is the process we follow. When the job is done, we'll do a walkthrough. After that, you'll receive an invoice same day. You have 5 days to pay. After 30 days, we take it to collections.
Right. So as I'm framing it up, and if I cut people off a little bit, I might, because I want to try to guide it back in. The drivers here, think of it. 1, sales drives it. Collections drives it. I guess timely invoicing perhaps drives it. Anything else? If you had a bullet, is there anything else that you can think of? And guys, jump in. You all have AR and collections in your company. What else drives AR? Good AR and bad AR.
A lot of processes, activities that drive into it. We have processes around decline credit cards, expiring credit cards, stuff like that will drive some of our auto bill stuff and prevent some of the decline credit cards, which is ultimately in our industry what leads to accounts receivable.
Does anybody engage their customer service teams in AR?
We do.
Okay, so thinking of all these different drivers, so we want to capture that, right? Because if we relentlessly focus on AR, that should speed up the amount of cash. Let me ask you another question, just rhetorically. When you have AR over 60, are you more likely to have a retention problem? Some companies do and some companies don't, right? So there's other things that happen there. Let's go to another team. So Bill, you were teamed up with Ashley, right?
Yes.
Okay. Who on your team found a good driver?
It's too chatty, I think. Sorry. Go ahead, Bill.
So Ashley, what is a driver of what driver in your business do you think you have?
If I'm understanding it correctly, I think, just mainly like client retention and upsells. I mean, so my business is IV Hydration. We go to clients' houses and we provide vitamins and nutrients intravenously. So one of the major drivers for our revenue would be, retaining these clients as members. And then being able to like upsell them on, maybe we started off with IV hydration and now we're selling them peptides. I would say peptides are like a major driver for us overall.
So if you were to pick one or the other,
Yeah.
which would you pick? Which is the great, which do you think has the greatest potential?
Client retention.
Okay. So as we go into the next breakout, I want you to keep that in mind. So everybody, what I want you to do is, as we go to the next step, I want you to be thinking about the driver that you've picked, because we're going to pick that one apart a little bit. So you have client retention. So what are the things that happen that drive retention in your business?
Sorry, trying to mute out the baby. I would say mainly like our nurses, and being able to speak to all of the services that we do provide, and really just establish that rapport with the client. So, sorry.
Let me step back then. So if let's think about this, everybody, in Ashley's situation, right? That's what drives business, right? It's the baby. It's the training of your nurses, right?
Mhm.
Your nurses have to know your product.
Yeah.
Also, I would assume that your communication skills of your nurses have to be really stellar, right? Because
Yeah.
they may not all be able to communicate, right?
Yeah, definitely. That's the kind of what I was getting at. Yeah. Just being able to speak to the clients in the proper way where they feel comfortable enough to, or not even just comfortable, that they really believe what they're hearing.
And I would have to believe that if you're dealing with, young nurses in the Z generation, we know their communication skills, they don't come work ready necessarily with communication skills.
Right.
What else, guys? Any other suggestions that you think, in Ashley's case, what else might be driving retention in her world, even though you're not part of her world? Sean, what do you think?
Well, I think we're in customer service-based companies, retention, a lot of it comes down to the service we provide and the quality of that service. So it's the people, the process we follow, what we deliver in the end, and is that of value to the customer?
Mhm.
Because if it's, like in healthcare, you break your arm, you're most likely going to go to a doctor or hospital to get it set. That's something that most people feel that they need to have. There's other things like in our industry, in pest control, maybe it's less important, right? It doesn't rank up there with a broken arm. So we have to be able to make sure the customer wants that or feels the need for that. And sometimes, especially when the economy starts to get bad, that may be something that they can live with, whether it's, one mouse or is it 100 mice?
Mhm.
Is it one bee or is it 100 bees? So showing that value to the customer, makes it, encourages that retention and the product that you're offering to them.
Mhm.
Scott, do you see anything? And then we're going to go to your team and see what driver you guys came up with. I'm curious if you see anything on the Ashley side.
Personally, like I said, I'm in financial control of the company, so I think gross margin. We have not been tracking as well as we need to our, like the product usage for our technicians. We know what the income is, revenue stream, but we're not really saying if identifying that we're getting the best prices we can by bulk purchasing some products and monitoring the usage of the products by the technicians. So there's
There's a
some
lot of
room
things
there.
that drive gross margin, right? So do you think in your world that product usage is the biggest driver of gross margin?
No, it's an area that we have not been tracking as well as we need to. So it's just an area for improvement for the company. Like I said, we're really, like I said, they're really tight on revenue. I mean, I know, customer retention is a big one, but since they're we have 4 locations, and we have not split out to what the usage is of products at those 4 locations, if there's any overspending because they're getting, products that were not really, on a bulk purchasing discount. We allow these guys to go purchase things for those locations without really, going over what's the best price we can get for these products, and we feel we're overspending on a lot of stuff.
So what I want you guys, what I want everybody to do is just hang on to, I want you to pick one. Because after we get through this next educational part, when we go to the next one, we're going to focus on one of the drivers that you've picked. So keep that in your head. Just know that ultimately we're trying to find 8, and we're going to show you what this all works out to be. So when we are looking at our company, when it's all said and done, we want your 8 cash flow drivers to look something like this. It's finding the 8 things that are most impactful on your company. And we're going to show you what we do with this next is, determining the potential impact, assigning a champion to each, and then having that champion relentlessly focus on that over and over again. And sometimes the person obsessing over it isn't the person that's driving it. You're going to have a choice when you make who's going to obsess over it. Sometimes we want the person who's responsible to obsess because they understand it, they know it, they live it, they breathe it, and they're going to make the most impact. Other companies pick the exact opposite. They pick somebody that has no idea because they want that person to get super curious and ask lots of questions. Think of it like the consultant coming into a company. And if you don't know anything, you're like the little kid who's looking up at the airplane and saying, how is it in the air? Why is it flying? Why doesn't it fall down? How did it get up there? And so you've got choices to make over which path you go when you pick your person who is responsible. When we went back to the 2 that we picked at Cooper in the example, we picked service delivery and client retention. So it looks like this. So that's where we start, but we're going to add more to it in a moment. And now we're going to be talking about finding the impact. So what is the impact of service delivery? What is the impact of client retention? So let's go back to the Cooper example. Now we're going to start doing some math. What we knew was service delivery equaled making that service manager great. And we knew it started with customer happiness. So the second thing that we looked, as we went through the example, at this point, when we started this journey, we were at 10 million in revenue. And we knew that each manager was responsible for, I'll call it a $2.5 million book of business. And we knew that if we could move 5 numbers, and I'll give you what those 5 numbers were, we knew if we could increase productivity, if we could increase the happiness of the employees, if we would increase the happiness of the clients, we knew that if the managers understood costs of goods sold, that they could drive their costs down, reducing costs. Oh, and by the way, we knew if their people really loved them, that we could then bring in more talent. That if we move those numbers, that we could increase gross margin by 2%. And we knew 2% of 2.5 million meant $50,000 for each team. And where I said 4 technicians, I actually meant 4 managers. 4 managers meant $200,000 in gross profit out there. That's a lot of impact. It's a lot of impact. And so then we decided our champion, in this case, we did say, we went to the subject matter expert. We said the vice president of operations would be the champion, but we struggled with that. We thought maybe we would go the other way and bring somebody in from a different department to oversee and manage, to look at that. And again, we drove it through the service managers. I want you to think about that for a second, but I'm curious on financial fluency of this group. I want you to take one quiet minute. I'm going to ask you a question. We have a $200 spray tank, and it falls off the back of the truck and breaks. How much additional revenue do we need to generate to replace the spray tank and get back to the same operating income? And when you give me the answer, you can answer it with a dollar amount. If there's a calculation you have in mind, you can give it to me. I want you to take one quiet minute, and then I'm going to go around the horn, and I'm going to see real quickly what each person has. So give some thought. Okay, now I'm going to go to Scott last because Scott should know the answer, I think. Okay, who wants to be my brave one and go first? Otherwise, I'm just going to start calling out names. You're all going to have to give me an answer. So,
I'll go.
okay, what's the answer?
Well, I think it's going to be depending on what your GP is on this. So it should be twice what your GP is on this scenario.
Okay.
So realistically, in our world, probably 400 to 420.
Okay. Matt?
I agree with that. And then I also was thinking about was the technician, like, was this on the way to do the work for somebody? Did we have to call somebody else out there? So there's other factors that I would.
Yeah, but I just want for keeping it simple, just know that I'm going to spend $200 in expense to replace that sprayer, put away all the other costs for a second. How much
Okay.
revenue do I need to generate to get back to break even?
Yep, I would say 2 times.
Okay, Sean?
Taking out the other factors, I'd say the same thing to double your, if you're working at a 50% margin.
Okay, what if you're working at a different margin?
I'd be scaled to that.
Okay,
You know, if you're only gonna 25%, then it'd be 4 times as much. You'd be at 800.
okay. Will?
Do it like the Price is Right. I will say, I think it's between 500 to 1,000, but
Okay.
I'll throw out 500 as a low number.
Okay. Ashley, any idea? Oh, you're muted.
Yeah, I was gonna say the same thing, like depends on your profit margin. So I would start with like 400 if you're at the 50% profit margin, but would go up if your profit margin is lower.
Okay. Scott?
I'd say 1,000 to 1,500 to get back the same operating income from loss of sales from the clients. I mean, to get, because you're basically taking a loss on the client sales. You have to get to that point.
Yep. And so where I want to take this in a moment is there's a million other factors that can go in. I just want to focus on the actual physical, let's just say the expense really was only $200. What would it be? I'm going to give you the answer, guys, because it's a calculation and you were all sort of there, but I want you to see how simple we make it. But again, it goes back to impact because the calculation, hang on a second. Here we go. It's additional revenue. It's expense divided by gross margin. So we all said if at 50%, 200 divided by 0.5 is 400. But if our margin goes down to 45%, it's $200 divided by 0.45, and it's $444 of revenue that we need to generate to replace. And if it goes up to 52% gross margin, the amount of revenue that we need to replace that would be $384. Who's confused by that concept? Anybody? And could you explain it back to your teams? Because, so I'll just be quiet for a second. And I see some people, I see some face. So again, what I want you to, the reason I do this calculation is not necessarily to teach, but to know that we have to be financially fluent. It's the financial fluency that becomes so very important. So now if we go back to finding the impact, and I was looking at service delivery. And so we knew that we were, in the Cooper example, that we were trying to find $200,000 of gross margin. And again, what is the calculation of that? It's the 2% of gross margin increase times the total revenue. We knew we were a $10 million company. 2% of 10 million was 200,000. And how are we going to get there? We were going to focus on our service managers. If we focused on our managers and we spent the time on them, that it would drive down to the technicians. And that was the driver. That was how we were going to drive that driver and what we were going to relentlessly focus on for that one. Then we turned our attention to customer retention. And so here, the math got a little more complicated. So we knew that the cost of adding an additional customer was measured through cost per acquisition. And we were at that point at $162 per acquisition. And our calculation. So putting in the calculation is very important, because how often do our teams calculate things differently? I was with a client last week, and we were measuring a certain item, and there was 3 different calculations in the room. The leadership team was not on the same page as to how we got to the math, what math we were using, what data we were using. So we have to get on the same page. And when we're doing a cash flow drivers, we want to declare the calculation. So we said our calculation was the cost of all the marketing costs, which came from cost per lead. And then we added in all the costs from the sales team. And I'm talking labor, everything. By the way, in our marketing costs, we included any agencies, anything that was marketing related. Oh, and that also included the cost of painting our trucks, because the reason we painted our trucks was because we wanted people to see them. And we included that in marketing. So however we're doing it, I don't care how you do it, you need to agree on your calculation. And then we divided that by the number of new clients. And that's how we got to our cost per acquisition. We knew that we had 8,300 clients. And we knew that we had attrition of 12% a year. And we knew that the only reason that a client could leave us is if they moved or died. That was the only acceptable reason. And we knew, what we didn't know though for sure is we thought that 50% didn't move or die. We didn't have that number though exactly. So it was a matter of, over time, gathering that data. And we said that if we could change 6%, we could get, there was 498 clients. So ultimately what we said was we wanted to have 498 clients stay with us. And at $162, we felt that that was $81,000 of impact. And we also knew that if we did this, we would have happier customers. We probably would get additional client referrals. And then we made our champion the customer service leader. And what was going to drive that? We knew, what we felt were the drivers were that we would increase our level of communication with our people, and that we would make them better at problem resolution. And if we did that, we knew that it was going to be cheaper to save a client than to replace the client. So we knew that replacing the client at $162 was very expensive, and that we could really increase the speed of growth. So this is what the 8 cash flow driver looked like. Oh, by the way, we're going to make sure that you get a copy of the video. It's available. You can take screenshots, whatever you need, and we can make the deck available to you also. But we said that we would be saving 81,000 in OpEx. The reason we were going to save 81,000 in OpEx is we knew we were going to, if we were losing, so let me go backwards for a second. If we were losing 12%, we knew that half of 12, because of 50%, the other half were people that weren't moving or dying, that we had 6% that we could potentially bring in, we could save. And 6% of 8,300 clients was 498. That's the math behind that. And we knew that if we had to replace those people, it was going to cost us $81,000 in cost per acquisition to get us back to revenue neutral. To be revenue neutral, that's what we needed to do. And that's the math behind it. So that's why we put that in here. And we knew, so this is how we lined up. We had training of staff, the WOW communications, the WO to WOW, and we made the customer service manager in charge. Now, these are only 2 of the drivers, right? So that's 1, 2. We still need to find 6 more. So here's what I want you to do now. I want you to go back and do a little bit of math for us. Go back to your breakout rooms and ask the things for the driver that you picked. What drives that number? How would you measure the impact? And then who on your leadership team should own the driver? I'm going to give you 10 minutes. And then I want you to come back and I want you to tell us what you found on the driver that you selected. So any questions before we send you off? So once, twice, Mallory, send them to the rooms, please. Welcome back. So hopefully your heads are swimming, and I'll just preface, I'm going to say it on, the next, after we get out through the breakout. If your heads were swimming a little bit when I was going through the calculations before, I was hoping to do that to you. That was intentional, because the math behind stuff is not always that easy. And it takes some work to be able to get to the numbers. So I'm going to call on 3 people. We're going to do this pretty rapid fire. The breakout's going to be a little shorter so that we can get you off. Bill Clark, tell me, on yours, what did you measure and what's the impact?
We spent a lot of time on Ashley.
Okay, tell us what we found.
So we talked a lot about bundles and memberships, and I think those are going to be the big drivers for her, is if she can continually take advantage of that client base, get them on some kind of a recurring membership, and then cross-sell her opportunities.
Now, were you able to nail a number down that, how much impact could we have if she focused on this relentlessly?
We didn't get that far into the conversation as we were working around some of these things, but I think it could be a huge thing for her to have that recurring model. You know how much I love recurring.
I do. Okay. Matt, were you guys able to come up with a number in your group, in your breakout?
Not a specific number, no. We just talked about like the impact and the different drivers that lead to accounts receivable. That's what we focused on, and didn't come up with a specific number though.
If you had to guess, what do you think the specific number might be?
So it would be probably days sales outstanding to get that number and to see how that impacts the bottom line with AR and everything.
And if you reduce, so just pretend with me for just a moment. If you had days sales outstanding right now is what? Do you know that?
I'm not sure what it was. We focused on Will's company, so I'm not sure what that number is.
If you were to reduce days sales outstanding, what do you think the impact could be?
I know how to calculate it. Yes. What the overall impact is would be just it's like threefold, right? You have opportunity costs, so you're not dipping into your line of credit. If you have cash on hand, you're able to take advantage faster of opportunities, whether it be marketing opportunities or new lines of business. You're able to make payroll. So you think about all the X factors associated with, if you don't have cash on hand to make payroll for 3 months and the sky falls in, what does that mean for workflow and business?
Yep. And so the harder part, guys, is the calculations, right? It's harder. It is harder. We're going to go there in a second. Sean or Scott?
Sean or Scott?
Were you guys
So-
were you able to figure out an actual physical dollar amount of impact?
No, we were still working on trying to figure out. So we had, ironically, the driver had in the first breakout, we're going with retention like yours, your example, but we were working on trying to get the background numbers in order to calculate it out. So no, we didn't get it completed.
That's okay. You know, and where what I wanted to impress upon everybody on the breakout was our next slide, which is, if I can get control of my screens, bear with me 1 second. There we go. Which is, it's hard. And so I'm going to give you a great story. Some of you may have heard this story before. Some of you may not have. This is Bill Stratton. Bill Stratton is an implementer in Lancaster, Pennsylvania. And I use this example over and over again. Bill Stratton was working with a company in manufacturing. And there's a lot of dollars out there. This company in manufacturing decided that one of its cash flow drivers was reducing waste. And they knew that they had a lot of waste, and they felt that if they relentlessly focused on waste, they could reduce waste by $3 million over the course of 3 years. And so they started, so that the impact, so they had waste as their driver, and the impact was 3 million. And so over the next 3 years, every quarter, one of their locks was a waste reduction effort, something new. And as they did each one, it became part of their standard operating procedure. So they kept chipping away, chipping away, chipping away. But the great part of the story was that that 3 million grew to more than 3 million. They actually impacted cash, they impacted it by 7 million. They reduced waste by $7 million by relentlessly focusing on it quarter after quarter after quarter. And what I want the takeaway to be is that they didn't know what that journey was going to look like. They knew that every quarter they were going to look at something different on that driver. So maybe when you guys were talking about customer retention before, maybe every quarter you are doing something new with customer retention and then making it part of your everyday. Or maybe we're looking at accounts receivable, and we're going to do every quarter something new with accounts receivable every quarter and making it part of our day-to-day. But somebody is looking at this all the time. In Bill's example in the manufacturing company, there was one person who just was the champion of waste. And that's what they did. They looked at waste all the time. So the 8 cash flow drivers is super meaningful and impactful. Also, I want to take away low-hanging fruit. See, it doesn't always have to be hard. I'll give you an example. It's a little self-serving, but again, still, I think it's not I'm not doing this to be self-serving, except to try to give you a good example. So at Cooper, we did not have a thing like what we call AGP. AGP is the frontline manager program that my other company does, but we charge our clients $10,000 per year per manager. Had Cooper been able to have that out there, they could have taken their 4 managers and spent 40 grand on them to put them through that. That would have taken the effort away from Cooper. The result would have been $200,000 in gross margin per year, with the final impact being $160,000 without a lift. My point being here, when you're looking at your cash flow drivers, I want you thinking about other ways of going about achieving it. It may not be just the people inside your company. It may be a third party, or it might be accessing some other information, or it might be a different hire that you bring into your company. And that's where I go back to where I started, which is the strong financial team. When we're looking at a cash flow drivers, I believe it's very important to surround yourselves with great partners. So the partners that I love, that I'm surrounded with and I talk to clients about, from an accounting perspective down in the Annapolis, Maryland area, Heim Lance, a great partner. I also think that you should having somebody that helps you with the concept of building to sell. And that is, again, in this case, a company called Strategic Exit Advisors. But what they do is they're an M&A firm, but they'll work with companies to help them understand the things that are driving valuation. Again, valuation is usually about those 5 numbers: revenue, margin, OPEX, net income. I also think about incentive plans. If we're doing all this with 8 cash flow drivers and we're making champions, maybe we want to incentivize our people. And there's a great company that does that called ProfitWorks. Alex Freitag is an implementer in the EOS community, another great resource. Maybe it's becoming financially fluent. And so there's lots of people out there that do this really well. But this guy, Mark Sissel, will help many of my clients become more fluent in their understanding. So when I was running by numbers earlier, and if you were glossing over with that, I suggest that our leadership teams should all be financially fluent, that it's not just the person in the finance seat. And somebody like Mark or somebody in your area should be able to help with that, but you want to surround yourself with somebody that can help your team become more financially fluent. And then finally, some companies need to bring in fractional help. And Pro CFO is a company that does that. I'm not saying that you should use these companies. I'm saying that you should probably, in your mind, have each slot filled and know when to pull upon them, because you need to assemble your team. Because when you're doing 8 cash flow drivers, it is going to take work to make it happen. Again, I bring you back to the great read on data that will reinforce many of the things that we did today. Know that we have the workshop series coming up. We'll make sure that you get this. This is the upcoming workshops and when they're going to be happening. And so I'm going to be sticking around for a few minutes afterwards, but here's my take home for all of you. I want you to tomorrow, even later today, to start thinking about the true drivers in your company. The 8 most important ones. Then I want you to take those 8 and figure the numbers and the math behind them. What is the impact? What are the calculations that you're going to use? And who's going to champion it? If you keep it that simple, that's what we're looking to do. And so I will stick around for some questions. In chat, if you could do me a favor and put in a rating for today, 1 to 10. 1, you probably could have done something. You shouldn't have come today. It was no good. 10, that it was worthwhile, that it got you thinking, that you have something to work with, and that you're going to be, it was a great session. So if you can put that in there. Also, if you think there's things that we can do to make this better in the upcoming workshops, we would love to hear it. We want to make these workshops the best they can be for you and for others. We want you to recommend the workshops to other people too. And again, next workshop on May 18th, we're going to be hitting the process component, which is process is in an SOP, building core processes that scale. It's 2 parts. And we're going to be looking at it, how we do process in EOS, 6 to 10 core processes. So I'm going to stick around for a few minutes.